some of the commentators say, no, gold prices only go up. It's been true for the last decade or so. But if you had bought gold at its previous peak around 1980 and you held on to gold, today, even after this big speculative bubble that we've had, you're back at the 1980 price, inflation adjusted, because of course we've had inflation over this period. Um, but you have just broken even in terms of inflation.
Hello, everybody. This is Pascal from Neutrality Studies, and today I got for the second time Dr. Randall Wray with me, who's a professor of economics at Bard College and a senior scholar at the Levy Economics Institute. Professor Wray is a great authority on modern monetary theory and the intricate working of the financial system, which is what we want to talk about again today. So, Professor Wray, welcome.
Oh, good to be back.
I was recently at a interesting conference, resource investment conference, and there I've heard again, like so many times before, people talking about the issue that only gold and minerals are real assets, are real money, because printed money that the central bank issues, that's just the government trying to control us all. And I hear that narrative quite a lot. Could we maybe talk a little bit about gold? And you made an interesting argument why buying gold might not be the best strategy after all. But could you maybe expand on that a bit?
Yeah, sure. So what I had claimed last time I was on is that the price of gold goes up and it goes down. And some of the commentators said, no, gold prices only go up. It's been true for the last decade or so. But if you had bought gold at its previous peak around 1980 and you held on to gold, today, even after this big speculative bubble that we've had, you're back at the 1980 price, inflation adjusted, because of course we've had inflation over this period. Um, but you have just broken even in terms of inflation. And this is sort of funny because people think, well, gold is a very good inflation hedge. You protect yourself if you hold gold. But if you had held gold, uh, you only would have maintained a constant value relative to the dollar, inflation adjusted. Okay. What if instead you had done what most investment advisors would tell you to do, is buy an index of stocks, say the Dow. If you had bought the Dow approximately at the same time, inflation adjusted, it is worth way over 10 times as much as it was in 1980. You would be more than 10 times better off if you had bought stocks. Now, stocks, of course, go up and down too, but historically, over longer periods of time, stocks beat inflation by quite a bit. And over a fairly long period of time, 1980, I don't know how old you are, but probably many of the people listening to this weren't even born their whole life. Gold has only managed to recover its inflation adjusted value. So, uh, and another thing that people say, well, if you're on a gold standard, that will keep the value of your currency constant. And then maybe if they looked on the internet, they saw that the um, the price level in the United States in 1800 was approximately the same as the price level in 1900. And they say, see, we were on a gold standard. It kept the value of the dollar constant. Um, but the reality is, if you look in between, the price was going up, it was going down, it was going up, it was going down. I mean, the price level taken as a whole, because typically what it would do is go up when we had a war, and then the price level would go down when we had a depression, and we had 6 depressions. in that period. And so those depressions wipe out the price level. And that's why at the end, if you take those two endpoints, you just happen to find that the price level is the same. If you're taking different endpoints, you wouldn't have found that. Okay. So anyway, now I would agree with part of the statement you started with. Gold is a real asset. The key word there is real. It's not a monetary asset. It's a real asset. Um, and gold has some nice uses. Your finger, your nose, your teeth,
The
but
phone.
it has industrial uses too, and it's shiny and people like it, and so it's a real asset. It has a real value, and I doubt the price will ever go to zero. It's probably always going to be positive. And on top of that, then we have the speculators who are speculating that it would go up, um, that other people will buy it because they think it's going to go up, including the gold bugs. You say it's a good inflation hedge. We just had some inflation. Price of gold goes up because some of them will buy gold thinking that's a good hedge. Um, and so, we can jump on that bandwagon and we can help push it up. And if governments start buying it, which they used to do on gold standards, that will help to push it up. The reality is if governments around the world release their gold stock, the value of gold would collapse because they're holding a lot of gold. So it's a real asset, but it's not a monetary asset. That's the key point.
Can you explain the difference? So a monetary asset, what is that?
It doesn't have a real form. It's not a real asset. It's a monetary asset. So there are several characteristics of them. The first one is that we have a money of account, and the money assets are denominated in that money of account. So in the United States, our money of account is the dollar. In Britain, the money of account is the pound, and so on. Okay. Every country has a money of account. And this is interesting because when a new country is formed, they almost always choose their own money of account. And we typically find every nation has its own individual money of account. Now, the euro area today, they all abandoned their own monies of account and agreed to all adopt the euro. We can come back to that later if you want. Very unusual. That almost never happens. Okay. So there's a link between the state and its money of account. And then the second thing is that the debts, monetary debts, are denominated in that money of account. So in the United States, all of my debts are denominated in US dollars. I could get into debt in euros if I wanted to. There are opportunities for me to do that. I don't do it. Most people don't do it. So our debts are denominated in the national money of account, typically. Okay. Those are two very important characteristics. Now, a lot of mainstream economists and just average everyday people will say, oh, money is also a medium of exchange. I can use it to buy stuff. So we make exchanges using money. And I can also hold uh, financial wealth in money form. I can hold money as a store of value. Okay. So it also has that characteristic typically. Um, Now, when we get down to the brass tacks, what are we willing to call an asset that has at least some of those characteristics to a greater or lesser degree? Okay. So I think everyone would say cash qualifies for all of those things. Medium of exchange, store of value, not a great store of value because you earn no interest on it, but you can hold it. And clearly, medium of exchange, it qualifies for all of those. How about a demand deposit? your checking account at the bank. Well, yeah, pretty much qualifies for all of those things. What about a savings account? Well, there's a little bit of a problem. In the old days in the United States, you couldn't write checks against your savings account. Now, typically you can, up to some number per month. But it's a little bit less convenient as a medium of exchange. It probably use much less than that. You can go to certificates of deposit that there's a penalty if you try to get your money out of the CD before the 90 days is up. So what I'm getting to is things have different liquidities. That is, how quickly can you get the value out of that financial asset and use
Yeah.
it as a medium of exchange?
And may I just interject here? It's really important to realize that we need to differentiate between these different ways of holding some form of value, right? Because when you talk about cash, you literally only mean bills and coins, right? Currency in circulation. You don't speak when you say cash. You don't mean what's in your deposit in your account, right? And these have because these have different functions. They work differently in the economy, and even I think bills and coins are actually under different regulations in the United States, right? Of who mints them. Uh,
And
but
issuers.
all of that matters when it comes to the way the system interacts.
Oh, we can get into the details of all of those things, and also people who work in financial markets will often broaden that definition of cash to liquid assets, including treasury bills. I'm not talking about the paper notes. I mean, 30-day bills. They'll say, oh, well, that's cash. It's as good as cash, right? I got to wait 30 days, but we can do that. So anyway, the terms are used sort of loosely. But what I'm getting at is what I think are the two key characteristics for our discussion is always denominated in a money account. And they are always a debt,
Right.
always a debt. Now, this won't be obvious to all listeners, but the little silver is not really made of silver. The silver coin is in the United States the debt of the Treasury. So our Treasury issues coins, and those coins are the Treasury's debt. Our central bank issues the paper notes. Our Treasury used to, but they stopped, and I think I've seen some, but they're very rare. Um, all of our paper money now is issued by the Fed. So that is a debt of the Fed. Okay. And so for me to consider something as being money, it has to have those two characteristics. It has to be someone's debt, and it has to be denominated in a money of account. So what about your bank deposit? Well, that's the debt of the bank. It's the liability of the bank. Your home mortgage loan is your debt denominated in the money of account, and it's the bank's assets. So this is every financial debt is somebody's financial asset. If I'm holding a coin, that's my asset. It's the Treasury's debt. If I'm holding a bank deposit, that's my asset. It's the bank's debt. So then, we can look at gold. Whose debt is that? Nobody's debt. And you denominate it in dollars. Well, yes, I could say gold is worth $32 an ounce, which it was for a very long time. Um, but it's denominated in a money of account, but it's nobody's debt.
Yeah, this is where a lot of people then argue that gold has intrinsic value, and that's what makes it, well, not only a real asset, but that's what makes it so much better than government debt and bills. And ever since the gold standard, since this hard connection between a dollar and an ounce of gold was severed, the government is basically just playing with money as a control mechanism. But this fundamentally misunderstands this issue that money itself, in order to be considered money, is always basically just a way to name a unit in which you count, which is inherently fictional.
Well, yeah, it has to be. It's a measuring unit.
Measuring unit.
It's the same as saying, I know the Europeans don't use inches, but this distance is an inch. Okay, it's a measuring unit. Can you hold an inch? No, you use it to measure. Can you hold $1? No, we use it as a measuring unit. Now, I know in the United States, we colloquially always call our paper notes dollars. Okay. Um, but if you take Britain, the pound was never minted or printed on paper until relatively recently. It was only a measuring unit. The shillings were the coins. So the United States, we uh, we we make it confusing because we use this term dollar to indicate two different things. One is a printed record of a debt. That's the paper note. And the other is our money of account. That's the measuring unit.
Right? Because in this sense, the printed record of debt is no different to a ticket that any kind of company could give you and say like, oh, here I hereby give you the value of one of these tickets in order to redeem something. You earn the right to redeem because it's
Right.
somebody's debt.
Free pizza coupon from your local pizzeria is their debt. And when you go submit it, redeem it for a pizza, they're no longer in debt. And of course, they just tear it up and throw it away.
Airline miles. There
Yeah.
is a lot of this private money circulating or being used by companies, but the point is they're not allowed to call it money, right? They're not allowed to think of it as or to advertise it as money. They can say it has the same value, but they need to say it's something else. So they give it different names.
Well, I'm not sure about that. They couldn't try to replicate a U.S. paper note. That would be called counterfeiting. Um, so I don't know the law on that, whether they could call it money, but it is their debt, and they do redeem it for miles
And now
flying.
you also argue that bitcoins are not money, and in
Yes.
general, like not just bitcoins, but all forms of what are they called?
Cryptos.
Cryptocurrency. It's called currency, but it's not actually money. Can you explain that one?
Okay, so we can use Bitcoin as an example because it's the best known. So Bitcoin really is a speculative, non-monetary asset. It's speculative. The main reason people hold it is because they think it will go up in value. It's not monetary because it's nobody's debt. Um, and there's very little alternative use for it other than holding it. Now, in the beginning, Bitcoin was sold as an alternative you could use to go shopping, and that unlike the dollar, it wouldn't go down in value when there's inflation. So again, it was an inflation hedge. That was the idea in the beginning. Reality is it's not being used in transactions very frequently. And the reason is because, look, so right now, Bitcoin is going up thanks to our new president. So the value of Bitcoin relative to the dollar and all the other currencies is going up. Okay, who's going to go to the grocery store now and spend their Bitcoins? Only an insane person because you believe it's going to go up in value. You're going to hold on to it. Uh, what if it's going down in value? No sane person is going to accept it for payment because it's going down in value. And so the problem is that it is highly volatile. And when it's going up, nobody wants to spend it. When it's going down, nobody wants to accept it. Now, I'm exaggerating slightly because it could be going down, and you say, I believe it's going to turn around. Okay. So you, as a speculative position, you start buying something that's going down because you think it's reached the bottom. You don't know for sure. You're taking a speculative position. You could turn out to be right, very lucky, make a lot of money. But the point is, again, that you're going to be holding it. You're not taking it because you want to spend it. You're taking it because you want to hold it because you think it's going to turn around and go up. So it's a speculative asset. That's what it is.
And as all assets, it depends on how many people want it and how many people want to get rid of it. Um, just because somebody calls it a coin doesn't necessarily make it money. But this trust toward government controlled stores of value or government controlled money that at a will, can be increased. So that's what the Fed does, right? That's what any central bank around the world does. It controls the money supply. Um, or can you correct me on
Mm,
that?
okay. Yeah, no. Central banks, Milton Friedman, beginning the late 50s, uh, managed to convince a lot of the economic profession and then all the people out there who read his books. He was a best-selling author. Um, that central banks can and do control the money supply, and that it is the money supply that determines the inflation rate. So if the money supply is growing, you're going to get inflation. So inflation is always and everywhere a monetary phenomenon, and it's always the central bank's fault. Okay.
You can call this the standard consensus among almost everybody who ever went into an economics class or even didn't. It's like the amen in church. This is
Yes.
dogma. Okay.
Yeah. Uh, from if he pretty much, I would say, won by the early 70s. Okay. But his winning was very short-lived because in 1979, in the United States, we had high inflation. We actually had what was called stagflation, high inflation, high unemployment at the same time. President Carter was in office, didn't know what to do. And so he brought in Volcker. Volcker said, I'm going to adopt Friedman's policy, which is we're going to control the rate of growth of the money supply. It had been growing fairly rapidly. We're going to bring it down, like Friedman says, to 4%, and that is going to eliminate inflation. So the Fed had its targets. It was never able to hit them. The rate of growth of money supply went up to 16% per year, and inflation came down. So it moved the opposite direction. And by the late 80s, the Fed gave up monetary targets. They still had to report them because Congress required it. In the 90s, they gave it up. And I can tell you, no central banker in any of the major developed economies believes this anymore at all. None of them target the money supply. None of them believe they can affect the money supply. None of them believe that the money supply is related uh, closely to inflation. They've all given it up.
But Randy, like I just want to challenge you so that you explain it here because the Fed prints money, right? So it can increase the money supply at will, right? It presses on a button and creates a lot. Can you explain why that's not the case?
Okay.
Why do they not control the money supply?
Yeah, the Fed does not do that. So, first, the Fed certainly does not just print up notes and put them into the economy. The way it actually works is you go to your ATM machine and we say you withdraw out of your deposit account, and the machine spits out the dollar bills. The bank contracts with some company, and they call them up. We need more, and they come and they fill it up. Uh, what the Fed does is it debits your bank's reserves dollar for dollar for every dollar that is spit out of the ATM machine. So it's not increasing the money supply at all. It is changing the form from bank reserves to paper notes. Now, let's go back to the global financial crisis when central banks adopted what Uncle Ben Bernanke, who became the head of the Fed, called quantitative easing. And so many people got the idea that what the central banks were doing was increasing the money supply. That isn't true. What they did was they went to banks and they bought government bonds and mortgage-backed securities from the banks. And they hold the Fed then holds those as assets. And
Which
then
are the debt of these banks? The
no, government bonds and mortgage-backed securities, which
sorry.
are like my debt. My
Right.
my mortgage has been packaged into a security. So mortgage-backed securities, of course, are a private debt. Government bonds are the government's debt. So that's what the Fed was buying. And ECB did the same thing. Japanese did the same thing. So they're all doing quantitative easing. All it did was change bank portfolios. Instead of holding a government bond, they're holding a deposit at the Fed. One is the Treasury's debt, the other is the Fed's debt.
Hmm.
That's all that happened. They're holding Fed debt instead of Treasury debt. Okay. And the Fed pays interest on the debt, so they still earn a bit of interest, but they're earning less than they were when they were holding Treasury bonds. Those reserves cannot get into the economy. They never got into the economy. They cannot. They're on the bank's balance sheet as an asset, and it is the Fed's liability, but it cannot leave the bank. There is no way the bank can give that to you
There's no
because
mechanism.
yeah, you don't have an account at the Fed. Only banks have accounts at the Fed, not just American banks. Foreign central banks can too. But the public can't get those. Firms cannot get those. None of that money got into the economy. Okay? Can't be done. Now, how can money get into the economy? Well, in the COVID crisis, first President Trump and then President Biden both engaged in fiscal relief. What did they do? They sent checks to everybody. If you could fog a mirror, you got a check. Okay. And what did you do with the check? You deposited it at your bank. Your deposit went up. That's treasury spending. Treasury spending puts money into the economy. Okay. Central banks can't do it. The treasury can do it. And it's called fiscal policy.
The
And it's the closest thing to what Friedman imagined a helicopter drop.
helicopter
Okay.
money. Yeah.
So he had said, this is what central banks do. And you say, really? Never seen one of those helicopters. Okay. They do not do that.
Now, the in this sense, like what the central banks do is they offer assets to the real economy for businesses to store and keep and maybe increase a bit their assets, right? But they no the
The central banks deal with banks.
mm,
They are the banker to the banks. They lend reserves to banks, or they can buy assets from banks, like buying government bonds, and that will increase bank reserves. So they can increase and lower bank reserves, but normally they only do it because the banks want it.
so because
It
there's a
is
demand for money, there's a demand for an
for
exchangeable good
reserves,
to deal with others.
only to deal with other banks.
Yeah, other banks among each other.
Reserves can only move between banks. So if my and why do banks need reserves? It's because if you write me a check and I take it to my bank and deposit it, my bank wants to get paid by your bank. And the way your bank pays is by transferring reserves at the Fed from their account to my bank's account. So that's what reserves are used for. If a bank is short, First, they try to borrow in the overnight market. In the US, this is called the Fed funds market, where banks lend reserves to each other. But if there's not enough extra reserves in the system, they go to the Fed and borrow the reserves from the Fed. Or the Fed buys a bond and credits their account.
Now, how do you explain to yourself that there's so much worry in among the general public and among a lot of the media as well about government debt? And you see these counters, right, that count how many trillions the government owes and say like this is unsustainable, this will collapse. I mean, it must collapse because we will never be able to repay the debt. Um, could you speak to that?
Well, first, governments do not and do not need to ever repay the debt. They do
That
not repay the debt.
this is counterintuitive. If they don't repay the debt, then somebody's going to go broke because they don't get the money back.
No, 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 no. What what they do is they pay interest. Okay. So the other day I bought some government bonds. We can do it on our computer, buy them directly from the Treasury. I don't have to go through a middleman. You just go to treasurydirect.gov. So you buy some government bonds, okay? And they debit your bank account and they debit your bank's reserves. And now I own a bond. Okay, why do I do that? Interest. So I'm earning interest and it's the safest asset there is. Okay, there's no chance. Let's put a little star there. We can come back to the possible chance uh, that the government's going to default on this. So why am I holding the bond? Because I want them to pay me back? No, because I want to earn interest. Now, I've been buying 4-week bonds. So at the end of 4 weeks, they do credit back my account uh, plus the interest. I buy them at a discount and then they give me the full price, but it's the same thing. So anyway, what do they do then? They just sell another one. Okay. So the bonds are never really repaid. They're rolled into another bond. If you don't want it, your neighbor wants it. Okay. So they're continually just rolling over the debt. And that's why the debt goes up. If you watch the debt, it's been rising since 1789 in the United States.
And there was no
It's
US default, yeah.
they've never defaulted, and we only repaid the debt one time, 1837, President Jackson, and we got our first depression after that. And we never paid down the debt again. I mean, we never retired all the debt again. Do we ever retire any debt? I mean, don't just roll it into new debt, but actually pay some of it off? Yes, we do, but only when there's a budget surplus. The only significant budget surplus we've had since the Great Depression was 2.5 years under President Clinton. That's the only significant surplus we had. And in those 2.5 years, they did reduce the debt. They paid some back. But otherwise, the debt is always growing. It's been growing at about a 2% pace faster than GDP grew since 1789. So what that means is it's not just the debt is going up, the debt ratio, the ratio of government debt to the size of our economy has been going up at a 2% pace since 1789. That's almost 250 years. The debt ratio has been rising. Is it sustainable? I would say if something has been going on for 250 years, it can go on. Okay. And I believe it will go on. It's going to continue rising.
Yeah, but the common sense reply to that is anything that goes up must come down. Why is it not the
It
case
doesn't.
in this sense for money? Because there's no reason. I mean, it's not physical. It's not a real height. There's no gravity pulling it down.
You know, does can GDP rise forever? can the our measure of the money supply, so we have a particular measure, we decide, let's count all the paper notes, all the coins, all the demand deposits, and most of the savings deposits. We'll call that money supply. That goes up too, all the time. Does private debt rise all the time? Yes, it does. It's always growing too. Okay. Does that mean your debt can increase forever? No, you're going to die. Somebody's going to want to get paid. Maybe on your deathbed, going to take everything you got. Okay. Uh, if the if your government disappears, the debt will disappear.
Right.
Probably a default. Okay. But as long as the United States exists as a nation, I believe the debt ratio will go up. The outstanding debt will increase forever if the country survive forever.
Yeah. And it is in theory, it doesn't even matter how high the debt is, especially debt to GDP. That's a measure that we often use, but it's just something made up in order to wrap our heads around that debt issue, which itself is also a mental construct. But um, do you think that the size of the population has something to do with it? Because by the current estimates, we will reach peak global population somewhere in this century, and from there, population might go down for the first time, like in a very, very long time. Could
The,
that be
the,
something that caps both GDP growth and debt growth?
well, it could, but it need not. We will make choices. We could choose to continue to grow. Um, and I mean, that's a great topic. We could do an hour on aging and the so-called challenges of aging and all that stuff later. Look, put it this way. So the U.S. has reached, the U.S. government, federal government, has reached a debt ratio of 100% of GDP. Oh boy, that's scary. Japan, 250% of GDP. Even scarier. Think about this. My debt ratio is probably 300% of my income. Are you worried about me? I'm not worried. Okay. When you have debt, what do you have to do? You actually don't ever have to repay it, and your bank will be happy if you don't. On your deathbed, yes, or maybe your children will pay it. But as long as you can pay the interest, that's the only thing that matters to the bank. And it's the only thing that should matter to us about the federal government. Now, I could take on so much debt that I couldn't service the debt and pay the interest. In that case, I'm bankrupt. That's a problem. I'm going to default. What about the federal government? Cannot happen. The federal government can always make the payments as they come due because they are the issuer of the dollar. The US Constitution says Congress alone can issue the dollar. They can always issue the dollar. Okay. And they do
Yeah.
it through keystrokes. So as long as they can pay interest, and I'm telling you, they always can pay interest. So we know that that's not a problem. But could paying a lot of interest be a problem? Yes, it could. Not that they won't be able to do it, but that there could be very bad consequences of it. And I would argue right now we're seeing that. And the reason is because not only do we have a high 100% debt ratio and the debt is growing, but we have very high interest rates too because of the Fed's monetary policy. They decided to fight inflation by going from, almost zero to 4.5%. And so government interest payments now are a trillion a year. Can the government afford to do that? Yes. What's the problem with it? It's increasing inequality because who holds bonds? Who holds financial wealth? Who holds real wealth? The top 1%, the top 1/10 of 1%. So government spending on interest um, could increase inequality. It could increase the spending by the recipients of the interest income, who tend to be higher income, of course. And so prices of luxury goods could be going up. Prices of luxury housing, yachts, and so on, vacations could be going up. So inflation could be a problem too, not just inequality. Inflation could be a problem. And in the case of the United States, the amount of our debt, federal government debt that's held abroad, fluctuates depending on how the dollar is doing and other factors. So right now it's relatively low, but sometimes it's 40% of all federal government debt is held outside the US. We're paying interest to foreigners. So it's worsening our balance of payments. Okay, dollars are flowing out to the rest of the world, which may not be desirable. So I'm not saying we should run up the debt and run up the interest payments. I'm not saying that at all. I'm just saying I'm not worried about solvency, but there could be other things I am worried about. Maybe impacts on the exchange rate, maybe impacts on inflation, maybe impacts on inequality. Those are all problems.
Japan is this interesting example in which this quantitative easing took place, and actually the monetary base of Japan, if you look it up, like quadrupled between 2011 and like a year or two ago, like really like four times up, really fantastic. And during that time, the central bank over here had a inflation target of 2% and barely managed to reach it. And then something happened about 2 or 3 years ago, which is suddenly the yen started going down, and actually also inflation picked up, although I do think they are not necessarily connected to the same phenomenon. But the yen now is really tanking. It's going far down, and people are saying, "Ha! Finally, we told you." It just took a little bit longer, more time. But in fact, what was explained to me is it had more to do with the fact that you earn more interest on money in the US than you earn over here. So a lot of companies which hold these government debt are exchanging it on the money market in order to invest abroad, which then pushes down the prices. Do you agree with that analysis?
It's hard to fight the Fed. If the Fed raises interest rates and your country is committed to keeping your rates down, then yes, this is the kind of problem you have. This is another reason I don't think the Fed should have raised rates, even for the US economy to benefit us. But it's a disaster abroad. Because if we go to four, Latin American countries have to go to 15 to
To keep the
avoid what
money
you're
in?
talking. Yeah. So and uh, the dollar is the main international reserve currency. There are competitors, and the dollar is declining in terms of global use. So it's gradually being somewhat replaced. But anyway, uh, because we issue that, we need to consider the impacts on other countries. And raising rates has been very bad for developing countries because they have to compete with that, with much higher because they are riskier than we are,
And the
right?
and the, the incentive then for the private economy in those foreign countries is to get rid of the local currency and buy US dollars and to invest into US denominated debt, right? And then that does harm to these local currencies.
Yes. Yeah. Another thing that has gone on for the past a transition the past 40, 50 years is to open up your capital accounts. And so it becomes easy to get uh, out of your own currency and into dollars. So it compounds the problem.
Um, Something that we've seen in the way that the monetary systems also internationally work, and I know you told me you're not working on that mainly, but um, I still need to ask this. Like one of the fundaments was basically that debt held by foreign governments, at least in the US, was more or less safe. But that consensus seems to have eroded quite a lot. I mean, the US US government seized Afghan assets of Afghanistan. It now recently seized, at least froze, assets from Russia, and the European Union is doing the same. So that now we are not in a world anymore where governments can hold each other's debt and be reasonably sure that that will continue through good and bad. How do you think that will impact the way that the international system works?
So, one of the reasons that the US dollar was accepted as the main international reserve currency is because there was trust in the court systems and in fair treatment, and that if there was a global financial crisis like we had in 2007 through 9, 10, depending on whether we're talking about Europe or the United States, that the Fed would step in. Well, the Fed did step in. We did the right thing that time. The Fed lent dollars. Uh, about 40% of all of the Fed's response to the global financial crisis was to save the rest of the world. About 60% was to save the US financial system. So that was the right behavior. But if you start interfering in the international payment system the way the US has been doing, that uh, is a crack in the trust of the US dollar. And so rival currencies can come about since the Britain and the US usually work together, and ECB maybe more or less. Um, then the alternative will be BRICS. And increasingly, we see that the Chinese RMB can be a reserve currency for some of the developing countries. So I think that could be the response, that some group of nations, maybe under BRIC, will replace the dollar for those countries.
Is there something that, like, Donald Trump already announced that he wants to fight this? Um, is there a way to fight this other than create or other than trying to reestablish trust? Are there heavy-handed methods that you can imagine that could compel other states to continue using the US dollar as the universal reserve currency? Like, let's say something like the petrodollar, the denominating, forcing the Saudis to continue denominating oil in US dollars, like things like that.
Yeah, well, we can choose what currency we will trade in, and the US is the biggest economy in the world. So, yes, I think that is a way to protect at least a large part of the globe in terms of dollars. But if you're not trading with the US, you're not trying to sell to the US or buy from the US, um, then I think you're much freer to say, we're not going to use it.
Right.
I, it, you know, it's not easy to replace the dominant currency. Remember, the pound remained the international reserve currency until the end of World War II. The US economy was already bigger than the British economy by about the Civil War. So it took a long time for the dollar to displace the pound. The pound's still important, but we became the dominant one only at the end of World War II. And I suspect the dollar will hang in there for a long time at current rates of growth. I know China's been in sort of a slump, but I think they're going to restore growth. At current rates of growth, the Chinese economy is going to be much, much bigger than the United States. Um, but do I believe the RMB will displace the dollar as the dominant currency? Not for a long time. You need to build up those relations. Other countries have to have trust in your court system, your laws, and in your central bank. will their central bank come to your rescue when there's a global financial crisis? I think we're a long way off from that.
And that might then also be the test, like the next financial crisis, how these aspiring nations will react. We are nearing the 1 hour mark, so instead of going into another subject which will blow us way out of that, I would like to thank you, Professor Wray. People who want to read about from you, they should go to the Levi Institute, right?
Yeah, www.levy.org. And I should have a couple of new things up soon.
Everybody check out Professor Wray's writings on levi.org. Professor Randall Wray, thank you very much for your time today.
Okay, thanks.